Welcome everyone to today's presentation on 2023 tax strategies. We are very pleased to have you here. My name is Ehab and I'm a financial advisor at Azzad. I am confident you will benefit from the information we provide you today, but we also must point out that there's no perfect tax management strategy. Every choice has benefits and limitations. No single approach is right for everyone because we don't believe there's a one-size-fits-all strategy. We highly recommend that you speak with your tax professional for information specific to your situation. For over 25 years, Azzad has been helping high-income professionals build their wealth in accordance with Islamic values. Today, we manage over $1.2 billion for more than 1,000 families across the U.S. What makes Azzad unlike many other financial firms is the quality and nature of our advice. It is centered around you and your family, driven by a higher purpose and designed to give you peace of mind knowing your financial life is on track. We help clients implement our advice using more than a dozen professionally managed investment portfolios. We make consolidating your investments under one roof easy by covering a variety of asset classes including halal fixed income, international, small, large, and mid-cap U.S. stocks, real estate, and even a dividend income strategy. Our investments track record spans more than 2 decades, with those of our institutional money managers spanning even longer than that. We like to consider ourselves your family chief financial officer. We believe financial freedom comes from knowing you're maximizing all your planning options. Our process starts by getting to know you, your needs, what matters most to you, and your risk appetite. Then we help focus on the matters that you can control and where we can make the greatest impact, like tax management, charitable and estate planning, and investment risk. We'll organize everything for you in a financial plan so you can track and measure your progress every year. No matter what stage of your financial journey you're on, we can help give you financial clarity. Here are some of the awards Azzad has recently received. This includes being named to the CNBC Financial 100 list in the Financial Advisor magazine RIA ranking list. Our investment strategies have also earned awards and have received PS10 Top Gun awards. Visit our website for more information on these recognitions, including the criteria required to receive them. Today, we're going to discuss 7 specific tax issues. First, we're going to recap some key tax rules. Next, ROTH conversions, healthcare laws and your taxes, distribution actions, tax-smart asset allocation, gift tax exclusions, and finally, giving appreciated assets to charity. We have a lot to cover, so we're going to keep this presentation moving. Turning back to the agenda, we'll start by doing a quick recap of key tax rules to bring everyone up to date. For the 2023 tax year, the standard deduction is $27,700 for joint filers, $20,800 for head of households, and $13,850 for single filers. The state and local tax deduction has a 10% cap, the same as in 2022. The child tax credit is $2,000 per eligible dependent for those with modified gross income below $400,000 if married filing jointly. The limits for deducting mortgage interest for buying, building, or improving your home stayed the same, with a maximum of $750,000 in principal value. The alternative minimum tax exemption increased. In 2023, the exemption for married couples filing jointly increased to $126,500, and the phase-out increased to $1,156,300. Now let's review some of the important changes that came into play in 2023 after the passing of the Secure Act 2.0. By far, the most critical changes was increasing the age at which owners of retirement accounts must take required minimum distributions from age 72 to age 73. If you have already turned 72, you must continue taking distributions. But if you're turning 72 this year and have already scheduled your withdrawal, you may want to revisit your approach. Also, starting in 2023, if you miss an RMD for some reason, the penalty tax has dropped to 25% from 50%. If you fix the mistake promptly, the penalty may drop to 10%. Catch-up contributions for workplace retirement accounts has increased from $6,500 to $7,500. From 2023 onward, employers can make Roth contributions to saving incentive match plans for employees or SEP plans. In 2023, the new tax law increased the credit available to help with the administration costs of setting up a retirement plan to 100% from 50% for businesses with less than 50 employees. From 2023 onward, QCD donations will adjust for inflation. The limit applies on an individual basis, so for a married couple, each person who is 70.5 years or older can make a QCD as long as it remains under the limit. The Secure Act 2.0 also introduced a number of changes to take place in the coming years. These changes include plan participants can use retirement funds in an emergency without penalty or fees. For example, starting in 2024, an employee can get up to $1,000 from a retirement account for personal or family emergencies. Other emergency provisions exist for terminal illnesses and survivors of domestic abuse. In 2024, companies can match employee student loan payments with retirement contributions. This rule offers workers an extra incentive to save for retirement while paying off student loans. Starting in 2024, pending certain conditions, individuals can roll a 529 education savings plan into a Roth IRA. So if your child gets a scholarship, goes to a less expensive school, or doesn't go to school, the money can get repositioned into a retirement account. However, rollovers are subject to the Roth IRA contribution limit. Roth IRA distributions must meet a 5-year holding requirement and occur after the age of 59.5 to qualify for tax-free and penalty-free withdrawals of earnings. Tax-free and penalty-free withdrawals are allowed under certain other circumstances, such as owner's death. The original Roth IRA owner is not required to take a minimum annual withdrawal. The new legislation aligns the rules for Roth 401ks and Roth 403bs with Roth IRA rules. From 2024, the legislation no longer requires minimum distributions from Roth accounts in employer retirement plans. Beginning in 2025, the Act requires employers to enroll employees into workplace plans automatically. However, employees can choose to opt out. Starting January 1st, 2025, investors ages 62 to 63 can make catch-up contributions of up to $10,000 annually to workplace retirement plans. The catch-up amount for people aged 50 and older in 2023 is $7,500. As part of the 2017 Tax Cuts and Jobs Act, lawmakers scheduled many of their tax law changes to expire. This table illustrates how the provisions are structured. For example, take a close look near the bottom of the table where it says doubled estate tax exemption. The state tax exemption in 2023 is $12.92 million, but that number will be much lower in 2025 unless the Congress acts. The Biden administration may look to adjust or change some of these tax law provisions before they are set to expire. It's important to remember, however, that legislative changes take time, and it remains unclear what initiatives may take priority. Here's what capital gains look like in 2023. In this table, we focus on long-term capital gains. The highest income earners pay a 20% tax rate. Those in the lower brackets will either pay 15 or 0% depending on their income. Please note that these tax rates do not include any applicable state taxes. As a reminder, you must hold a security for at least 12 months to qualify for a long-term capital gains treatment. Short-term capital gains, those appreciated assets held less than a year, are taxed as ordinary income. One side note before we leave this image, ordinary dividends is treated as ordinary income. Qualified dividends are subject to the same 0, 15, or 20% tax rate that applies to long-term capital gains. Keep in mind that this guide is for informational purposes only, and it's not a replacement for real-life advice. So make sure to consult your tax, legal, and accounting professionals before modifying your tax strategy. Let's take a deeper look into 401ks and traditional IRAs. Regular contribution limits went up slightly this year for 401ks, but there was no change in catch-up contribution limits. Taxpayers may now contribute up to $22,500 to their 401ks, 403bs, most 457 plans, and federal TSP plans in the year 2023. The catch-up contribution limit for employees ages 50 years or older is now $7,500. The limit on IRA contributions also increased by $500 to $6,500 for 2023. Individuals ages 50 years or older can make catch-up contributions of an additional $1,000. As you consider your choices, remember what we discussed a couple images ago. In most circumstances, you must begin taking required minimum distribution from your 401k plan, traditional IRA, or other employer-sponsored retirement plan in the year you turn 73. Withdrawals are taxed as ordinary income, and if taken before the ages of 59 and a half, may be subject to a 10% federal income tax penalty. Also, contributions to a traditional IRA may be fully or partially deductible, depending on your individual circumstance. Now, we will see slight changes to IRA deduction limits and Roth IRA cutoffs. The tax deduction for traditional IRA contribution phase-out ranges depending on your filing status and your workplace retirement plan coverage. Single with the workplace retirement plan, the phase-out is between $73,000 to $83,000, which is an increase on $5,000 on both ends. Married filing jointly and the IRA contributor has a workplace retirement plan, the range is between $116,000 to $136,000. Married filing jointly and the IRA contributor does not have a workplace retirement plan, but their spouse does, the range is between $218,000 to $228,000, which is an increase from the prior range of $204,000 to $214,000. The AGI phase-out ranges for Roth IRAs rose in 2023. Single and head of household, the range increased to $138,000 to $153,000, and for folks marrying filing jointly, the range increased to $218,000 to $228,000. Converting from a traditional IRA to a Roth IRA offers tax-free withdrawals on taxable contributions. To qualify for a tax-free withdrawal or earnings, a Roth IRA must be in place for at least 5 tax years, and the distribution must take place after the age of 59 and a half, or due to death, disability, or a first-time home purchase. Depending on state law, Roth IRA distributions may also be subject to state taxes. We've covered some of the highlights of the current tax law. Now let's move on to talk about Roth conversions. While a Roth conversion is not right for everyone, it does provide advantages for some investors. In a Roth conversion, you may withdraw money from a traditional IRA to pay federal and state taxes due and move the funds into a Roth IRA. All future growth and withdrawals are then tax-free. Roths also don't have RMDs, which can play a role in estate strategy. One important detail to note is that you cannot undo a Roth conversion. If that is something that you want to discuss, talk with your Azzad advisor. Finally, Roth conversions have come under much scrutiny during the past year. Congress has considered legislation that would prevent high-income Americans from performing Roth conversions. While no such action took place in 2022, it is possible that Roth IRA rules may change in the future. Converting from a traditional IRA to a Roth IRA offers tax-free withdrawals on taxable contributions. To qualify for tax-free withdrawal or earnings, a Roth IRA must be in place for at least 5 tax years, and the distribution must take place after the ages of 59 and a half, or due to death, disability, or first-time home purchase. Depending on state law, Roth IRA distributions may be subject to state taxes. Let's talk about how healthcare may affect your taxes this year. There are 2 additional taxes that may affect high-income taxpayers: the additional Medicare tax and the net investment income tax. Let's start with the additional Medicare tax. As of 2013, high-wage individuals pay an additional 0.9% on wages above a certain threshold. Who's subject to that additional tax? Well, if you're married and filing federal taxes jointly, you are subject to a 2.35% tax on your combined wages that exceed $250,000, as compared to 1.45% tax that you pay on wages below that threshold. If you're married but filing separately, the additional tax will apply to wages that exceed $125,000. For everyone else, the threshold is $200,000 of wages. Let's take a look at an example. A single individual in 2023 with wages of $240,000 would owe a tax at a rate of 1.45% on the first $200,000 and then 2.35% on the remaining $40,000 of wages for that year. The second Medicare tax affects investment income, also known as unearned income. Before 2013, you didn't have to pay Medicare taxes on investment income. With the net investment income tax, however, certain high-earning investors have to pay an additional 3.8% tax on income received through investments. People who have to pay this tax include individuals with modified AGI above $200,000, people who are married filing separately with an AGI above $125,000, and for couples filing jointly with an AGI of more than $250,000. Some estates and trusts are also subject to this tax. The tax applies to many investment types of income, including dividends, capital gains, rents, and royalties, non-qualified annuity income, and any business income considered a passive activity. The tax does not include retirement plan withdrawals, Social Security benefits, and several other income types. The particulars are complex, so we recommend that you consult a tax professional who can help you understand the rules. The threshold amounts haven't been indexed for inflation, meaning they haven't changed since 2013. Therefore, they potentially affect more taxpayers each year. If you spend a relatively large amount of money on health-related services, you may be able to deduct those expenses from your taxes. For 2023, you can deduct medical, dental, and other healthcare expenses that exceed 7.5% of your adjusted gross income, the same as in 2022. These expenses include those associated with diagnosing, treating, or preventing diseases such as prescription drugs, some insurance premiums, medical equipment, and travel costs for appointments. Remember, you may not be able to deduct reimbursed expenses. Now, let's look at some details you should consider when taking retirement distributions. Another way to help keep more of your hard-earned money is to think about how taxes affect your income strategy. Here are some ways to potentially avoid tax pitfalls when taking distributions. Inventory all potential sources of retirement income. The list may include all your retirement accounts and any other accounts you manage. Review the tax treatment for each item and how a change to your income source would affect your taxable income. As an example, if you move money from a taxable account to a tax-deferred account. Determine whether you should consider adjusting your asset allocation to move assets into tax-deferred accounts or maximize contributions to reduce your reportable income. Asset allocation is an approach to help manage investment risk. Asset allocation does not guarantee against investment loss. Find out the distribution rules for your retirement assets. In most circumstances, you must take required minimum distributions from your 401k plan, traditional IRA, or other employer-sponsored retirement plans in the year you turn 73. Withdrawals are taxed as ordinary income, and if taken before the age of 59 and a half, may be subject to a 10% federal income tax penalty. Create a strategy to minimize taxes, especially if you fall on the highest income tax bracket, and determine when you will pass that asset to your heirs. We understand if some of this information seems confusing or complex, making an informed choice for your distribution is critical, and another reason you should consult with your Azzad advisor and a tax professional. On to our next point. Asset location. Asset location, not to be confused with asset allocation. Attempts to manage your tax liabilities by taking advantage of different tax treatments that some investors offer. Using this approach, some investors strive to maximize their after-tax returns by strategically determining when securities to hold in a tax-deferred account and which to hold in a taxable account. How do you know what's the best for your assets? A sound strategy depends on several factors, including your age, time horizon, and risk tolerance. If you'd like to explore asset location to see if it's an appropriate strategy for you, we strongly advise you to consult with your Azzad financial professional and a tax professional to discuss your opportunities. Now, let's talk about getting the most out of annual gift tax exclusions, which can be a powerful estate tool. The gift tax exclusion allows you to give $17,000 to anyone in 2023 without having to use your lifetime exemption amount. As long as you limit the gift each year to that year's exclusion amount, the IRS does not require the giver to file a tax return. No gift taxes will be due. The $17,000 exemption is indexed for inflation and granted separately for each recipient. Here's an example. A couple who has 3 children, the 2 parents can give a total of $102,000 to their children. That's $17,000 to each child by each parent, or $34,000 to each child. Again, this does not apply to the lifetime exemption. Recipients of gifts do not have to pay gift taxes. Donors are responsible for the taxes. The simplest way to use the annual exclusion is to give cash or other assets to as many people as you want each year. Even if you give more, you still won't have to pay federal taxes, at least until you reach the lifetime gift exclusion of $12.92 million in 2023. You may give more money to individuals by making direct payments to certain qualified medical, dental, and tuition expenses. These payments don't count against your annual or lifetime gift exclusions. Our final point is giving to charity. Why did we leave this topic for last? We wanted to focus first on helping to ensure your financial house is in order before examining how you can support the causes you care about. Ultimately, this is one of our primary goals at Azzad, to help our clients build financial lives that reflect their values. We would be remiss if we didn't mention that, thanks to certain tax considerations, giving in the proper manner may be able to provide you, the taxpayer, with worthwhile tax deductions. I hope you feel that you've benefited from today's presentation and gained some insights and valuable perspectives on your tax circumstances. I understand that all this tax information may seem complex. Fitting so many new details in your financial vision can sometimes make the horizon less clear. Just think, we haven't discussed inflation, longevity, risk tolerance, the emotional cycles of investing, and all other related factors. But that's where we come in. As investment advisors, our job at Azzad is to help you cut through the clutter and to find a path forward. That way you may have the ability to build a portfolio that aligns with your goals and values, even as tax laws and market change. At Azzad, we can help you in 4 key areas: analyzing your needs and goals, helping you select suitable investments, setting realistic performance expectations, and monitoring your portfolio and recommending changes over time. If you have any questions about today's presentation or would like to discuss any of these tax planning strategies, give us a call. For more information and timely updates, please follow us on social media and visit us at azzadasset.com. We hope that you've enjoyed today's presentation. Thanks again.